Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, August 4th, 2025. To begin with, I have to apologize. Last week I was out on vacation and failed to mention that our previous podcast, so we did miss one last week. Sorry about that, but we're going to get you caught up this week. We'll go over the economic activity last week, which was huge, look at the returns, and then of course look at what the economic activity, the data points that will be released this week. So last week, holy moly, first 4 days, great. Friday, not so good. So let's go through the economic releases during last week, which the buildup for that was, it looks like the economy is slowing. We've talked about that. We've talked about the fact that the labor market seems to be cooling as well. But we got data points earlier in the week last week, which sort of suggested maybe the economy was fine and maybe labor was doing well. And then Friday occurred. So we'll talk about that. But starting with last week, Tuesday, with the JOLTS job opening, we don't usually pay a lot of attention to this, but you may recall this indicator back in 2022 with the inflation spike peaked out at over 12 million new jobs openings in the U.S. and labor shortage and driving prices up. Well, that's now well below 8 million. But the release for the June JOLTS report was actually better than expected. So slightly worse than expected. It was expected to be in 7.6 million roughly and came in at 7.5 million. So from a jobs opening standpoint, a little weaker than expected, but not bad. But then the next day, ADP employment report. So ADP, different methodology than the Bureau of Labor Statistics uses, much smaller sample. It's only corporate clients that they survey. That was expected to come in for the month of July at 75,000 new jobs, and actually stronger than expected at 104,000. So that was positive news. Same day, the second quarter GDP number came out, first release of it. The consensus was 2.4% increase in the second quarter, and it came in at 3%. So that looked really good. Now, we continue to point out that 3.0% GDP, whatever the number came out in the second quarter, was going to be abnormally high given what happened in the first quarter. And the issue there was tariffs, concerns about tariffs, about individuals and corporations buying in inventory in advance of potential tariffs. So it spiked our net imports way up, which decreased our GDP to a negative number in the first quarter. So in the second quarter, some of that was released. So it's a bit artificial, 3% growth, fine, but just take a look at that with that negative 0.2. In the first quarter, we add those together, you've got about a 2.8 or 1.4%, we'll call it 1 to 1.4% GDP growth rate here in the first half of 2025, which is fine. It's not as strong as it was last year, but we've definitely cut back on, it appears, government spending. And so now with the tariffs, percent and a half GDP growth, pretty respectable. So we received that news on Wednesday. At the same time, the Federal Reserve, they kept interest rates flat, which was what was expected, so no drama there. Thursday, we got PCE numbers, both core and headline numbers. Those were exactly in line, so really nothing to talk about in both cases. They came in an increase month over month of 0.3%. Personal income actually better than expected, was expected to come in at a positive 0.2 month over month, came in at 0.3, and personal spending slightly worse than expected. It was expected to come in at about 0.4% month over month, and it came in at 0.3. So those are all pretty decent numbers, I would say. Initial claims actually came in better than expected. It was expected to come in at 224,000, came in at 218. So good news. And then we roll into Friday, non-farm payrolls. So the headline number here is bad, and the market reacted to that. But it's not really the number for July that really mattered. It was a revision to June. So we'll take July first in order. We'll take July. So July, the expectation was we would have added 110,000 new jobs, which was deceleration from the prior month. And it only came in at 73,000. So in and of itself, disappointing. But by far the bigger disappointment, June. So June initially was printed at 147,000 new jobs. The revision cut that to 13,000. Huge cut. So between those 2 months, it is very clear, at least the way the BLS calculates and receives all the information on payrolls, significant slowing over the last 2 months from what we had seen during the first 5 months of the year. So that was hugely negative. Unemployment rate right in line, average hourly earnings right in line. Michigan Consumer Sentiment Index also came out on Friday, missed slightly, came in at 61.7 versus a 62. So you take last week in total, everything else looked relatively favorable if you take it as a grouping, but the payroll number, the non-farm payroll, really roiled the markets. So we'll look at what happened in the markets, but you had a huge rally in the U.S. bond market and conversely, a big sell-off in equities. So other news from last week, or at least data points, we mentioned GDP growth, second quarter printed, first print 3.0%. The first estimate now for the Atlanta Federal Reserve for the third quarter, which we're in already, very surprised by this, 2.1%. And based on the whatever we saw in the first half of this year, 2.1% would be, I think investors would love to see that. Would have to say that it appears a little bit high. So inflation expectations, nothing to speak of here again, except for the fact that the 10-year implied expectations for inflation is 2.33%, pretty static with most of this year. The Federal Reserve did not cut rates, but because of what happened Friday with the labor numbers, the futures market changed dramatically in terms of when we should expect cuts and in what magnitude. So prior, just a week ago, there was a 63% probability that we're going to get 25 basis point cut in September. That rose to 87%. Then by the end of the year, December, the odds of 2 cuts, that increased last week from 64% to 93%, and the probability of 3 rate cuts by the end of the year, that had been at 21%, came in at 58%. So expectation is the economy's slowing because of those labor numbers, and the Fed is going to have to step in and save us by the end of the year. Another Fed put scenario. So what happened in the markets? Again, last week, things were going pretty well until what we ended up seeing on Friday with the labor numbers. So as a result of that, huge sell-off in the U.S. equity markets on Friday. For the full week, S&P 500 down 2.3%. For the full year, on a year-to-date basis, up about 6.9%. Last week, growth actually outperformed value, which is a little bit of a surprise. Usually in a big pullback, you see value outperform. But small really lagged large. Large was down 2.1, and small was down 3.3. In terms of international, also things didn't go well there either. The developed markets, ex-US, was down 3%, a little worse than the S&P 500. Emerging markets down 2.5%, and a lot of that driven by China, weakness in China, although it's had a great year to date, up 19.4%. Last week, China down 3.5%. Fixed income, I mentioned, huge rally last week. The 2-year Treasury yield dropped 24 basis points. The 10-year dropped 17. So this is just a massive bond rally. It doesn't sound like it compared to equity, but it's huge. The Bloomberg U.S. Aggregate Bond Index was up nearly 1% last week. It was up 0.95%. So now on a year-to-date basis, it's a positive 4.6%. So that's it for last week. This week, fortunately, given all that economic activity last week, kind of a breather week, only 2 announcements that we think might be significant. One is tomorrow, ISM Services Index. Again, 50 is a demarcation line between expansion and contraction. The consensus expectation is 51.5, which would be an increase in July from the number printed in June, 50.8. And then the other data point, as we have every week, initial jobless claims. Again, last week was 218,000. The expectation is a little higher this week, still at a pretty tolerable 220,000. So that's it for our recap of last week and preview of this week. We thank you very much for your attendance. We hope to see you next week. Thanks.
you.